Welcome back. Today we're talking to two fund managers at the end of reporting season. They're both in Melbourne. As such, they're suffering from lockdown fatigue, but certainly their fund's performance hasn't been suffering from lockdown fatigue. They've both performed particularly well since the problems of February and March earlier this year. So we're talking to Dean Fergie from Cyans, and we're talking to Rodney Brott from DS Capital. Welcome, gentlemen.
Thank you.
First of all, can I ask you, Rodney, how's reporting season been? Has it been expectation? Have you found it difficult? What's the general feeling been?
Thanks, Chris. Well, we're obviously a long way from the depths of the market in March. So reporting season was better than expected, I think, across most sectors, and part of that was the low expectations going in, and part of that is the current phenomena that's favouring equities, and that is low interest rates. So our portfolio fortunately had some of those winners in it, and we had made a few changes to the portfolio in the in the period leading up to reporting season. But in most cases, there wasn't a great deal of guidance. In some cases, the results were pre-reported, and there were different, I guess, buckets of businesses that performed differently. There were the businesses that were winners out of this current crisis, like the online businesses. There were businesses that maybe temporarily closed, but like some of the retailers, and there are businesses that will continue to be structurally challenged by this changed environment, such as the tourism businesses.
Rodney, were there any nasty surprises?
Fortunately, not in our portfolio. We managed to avoid them. If you judge, we look more at the results themselves rather than the performance of the share price, because the short-term performance of the share price is more about the psychology, emotion, and expectation at the time. But amongst the results, there was nothing in the businesses that we own that really caused us to scratch our head and question our investment thesis.
Dean, can I just turn to you for a moment? How did Cyans fare in the reporting season, and do you have a different view to Rodney on the overall performance of the market or overall performance of companies in reporting season?
Yeah, thanks, Chris. Look, I mean, broadly, I agree with everything Rodney said, that the market's being driven by low interest rates and money flowing into the sector. But what we saw, a couple of things I think have been really interesting and perhaps a little bit surprising about the market is how buoyant the economy's been, with the amount of, I guess, government handouts that have been swirling through the economy. It just seems to have driven so many businesses, and in many cases to record results which you wouldn't have expected. Secondly, which has been driving the market, there seems to be a lot of retail punters investing in the market, a lot of day traders, which are driving volumes, and I think a lot of strength in the market. So, look, we've been having some really, really good results in our portfolio. I think, one, because the underlying financial results have been better, but also because there's been just remarkable buoyancy in the stock market. The emerging companies index is back above where it was pre-COVID, and looking at that versus the outlook for the economy, certainly here in Victoria, is very dire. It's a little bit confounding, but obviously you've got to be enjoying the run of the stock market, because if you've got your money sitting in the bank, you're not making any money at all.
There seems to be somewhat of a disconnect there, doesn't there, between what the market's saying. We've just seen numbers yesterday. We're officially in a recession. That shouldn't be a surprise to anyone. If anything, it might be that we weren't in a deeper recession, but this is going to last for some time. So is the market out of touch with the economy, or is just the market moving ahead of the economy, as it always does?
I'd probably talking against my own book, but I tend to think the market's been a little bit too optimistic about the outlook. I think the economy for the moment is probably being artificially propped up a little bit by government spending, and there's a bit of a cliff we're going to fall off, is my view. Now, when that happens, I just don't know. I guess the issue is if you were bearish 3 months ago, you would have missed out on a return of kind of, well into the double digits. So I think you've almost got to have a foot in both camps, because the market has got such strength behind it. You can't afford to be not in it, but you also, I don't think, can afford to be sitting back saying, hey, everything's all fine, because it's clearly not going to be.
Rodney, your view on that?
Oh, look, I tend to agree with what Dean has said. The markets are certainly more buoyant than people expected. There's an element of fear of missing out. The fact that interest rates are so low is driving investor behaviour and potentially, which is what what Dean was alluding to, mispricing the risk of taking your money out of the bank and investing in stocks. The stock market is, one of the most liquid venues for investment, and therefore it's attracted money very quickly when the market dipped, and I think will continue to do so, because we are now in a situation where we're 6 months into this crisis, and we are, in my mind, we're not near finished, both in terms of the crisis itself and the implications of it. And we've seen what businesses and what sectors do well and which ones continue to face challenges. So armed with that experience, I think if there are any pullbacks, it'll be more discerning than the market weakness that we saw in March earlier this year. There is probably still an element of disconnect based on the free flow of stimulus and other support measures that are being put in place by governments, and it'll take some time to sort of wash through the system. But I do feel that, and I don't want to speak for Dean, but in our case, being a fund that focuses on looking at businesses from the ground up, these sorts of macro events that lead to some emotional selling and distress selling, etc., and just more volatility, provide funds like ours with a lot of opportunities to buy businesses that we've been looking at for a long time at attractive prices. So that the volatility doesn't really worry us. A continuing disconnect between the stock market and the economy would be a bit of a worry. But even within a tough environment, funds like ours can find businesses that are doing well, that are niche providers of a product or service, that are able to grow in a tough environment and maybe take opportunities from competitors falling over or new ways of doing things. And then when the economy recovers, they'll do really well.
Have you had to adjust or change the portfolio or turn the portfolio over as a result of COVID?
Look, we made some changes in March, probably more changes than we would usually make, but they weren't material. We probably made mistakes with some of those changes in cutting a few things, but we repositioned reasonably quickly, having raised a bit of cash at the time when there was that very high level of uncertainty, and our philosophy of protecting capital first and then getting a reasonable return on that capital second, forced us to be a little more defensive. But then we added to some of the positions that we felt were doing well in that environment and continued to do well. So some of those moves had paid off, but they were more pivots within our wheelhouse and our portfolio rather than wholesale changes. Where we added to data centers, we added to online businesses. We resisted the temptation to add to tourism and those sorts of things. So we did make changes, and we added a few new positions that we'd sort of looked at for a while, but their price was beyond us, and we could take that advantage we could take that opportunity in the sell-off. But they weren't major changes. The portfolio still looks a fair bit like it always has.
So more of an adjustment. Dean,
Sure.
from your perspective, have you done the same or seen the same thing happening within the portfolio?
Yeah, look, we probably, in some respects, we took some pretty extreme views. Look, I don't think we were alone in not realising how big an effect COVID would have. But having said that, we cut a number of our tourism-related assets pretty quickly, and I think that was the right thing to do. We've not added to a couple of positions that have probably been smart as well. There are a few businesses that looked really tough and were trying to raise money during that time, and we haven't added to that, and I think that was also positive. You know, what we didn't do as effectively is probably dive into a lot of the stocks when they became bargain priced. I guess the window for that opportunity was very brief, and it bounced back pretty quickly. I mean, we did make some positional changes that have worked really well, but I guess you look back and you say, gee, we should have invested more at the bottom, but no one rings the bell at the bottom and no one rings at the bell at the top. So it's really hard to do effectively, is to go through a market that falls 25% in 3 weeks and then bounces back 25% the next couple of months. So I think anyone that says they've traded that perfectly is just a liar. But I think overall we've navigated it pretty well, and I think we've probably come out better or ahead of most others. So that's been pleasing.
Just looking to the future for a moment, is there any particular sort of vision you have into the future, having talked about hindsight being so wonderful? How's the future looking?
In our case, the future looks as uncertain as it does to everyone. But we feel that, and we're carrying probably about 19-20% cash at the moment, that we'll use when opportunities present. So, I mean, we have no particular strong view about a vaccine. We have no strong view about what happens when stimulus wears off, or if it ever wears off. We have no strong view on the big macro issues, and we've just been focused on talking to the companies that we're invested in and that we're interested in, and trying to understand how they're adapting to this very unique environment. And we're fortunate to be able to operate in an asset class that provides liquidity and allows us to adjust our strategy according to the environment. But at the end of the day, we're more interested in how these businesses are going to look in 2 or 3 years' time, rather than what their share prices will do over the next few weeks or months even, because the short-term psychology and emotion will determine today's share prices, whereas the fundamentals of a business will determine their long-term price, and that's what our focus is on. Thanks,
Rodney. Dean, any final words from you?
Yeah, look, I guess our view is that there's certain sectors we just don't want to be in, that we think this COVID will change the world for quite a long period of time. So anything that's in tourism, consumer lending, hospitality, commercial real estate, we think they're very dangerous sectors and just worthwhile staying away from. On the positive side, the market, with all its buoyancy, means there's going to be a really strong pipeline of new IPOs, more capital raisings and the like, and funds like ourselves and Rodney's that are pretty active in that space. There will be a lot of opportunities over the next 3 to 6 months in order to be able to deploy some capital into probably some new and attractive positions. So whilst the outlook is going to remain pretty uncertain, I think that's quite a big silver lining for funds that are small and nimble and are looking around for new opportunities. That's what we're most excited about, I'd say, Chris.
Gentlemen, thank you very much for your time. We really appreciate it. We'll look forward to speaking soon.
Thanks, Chris. Thanks, Dean.
Good on you guys. Always good to chat.